Hello, dear students. How are you all? Hope all of you are fine. So today in our today's personal investment management class, we are going to start with the new chapter, that is the fourth unit. Okay. So the fourth unit is investment in mutual funds. So students, about mutual funds, we have discussed briefly in the second chapter, if you remember, that is investment avenues. Okay. So there a term was there. There we have discussed about the different investment options that are available. So we have seen that a lot many options were there, isn't it? Those investment options where risk is very high and risk is very low, isn't it? Where returns are very high, where returns are very low. So depending, we have learnt about the different avenues that is available for an investor so that he can invest and earn good returns. Okay. So in that we have already discussed a small topic, that is mutual fund. So today, here we have the mutual fund we are going to discuss in detail. Okay, so this chapter, that is the fourth unit, it is investment in mutual fund. So students, I hope you have heard about the mutual fund, isn't it? So what are mutual funds? Okay, you have heard of it, and we have discussed briefly in our previous chapter. So what are mutual fund exactly? Now today it's very common. Like today, it's the mutual funds. They are very popular. So one of the option that investor go through for investing, they are in they go for mutual funds. Now, mutual fund, it is actually an investment vehicle. Okay, it is an investment vehicle formed where an asset management company or a fund house. Okay, we have an asset management company. Okay, a company is there who will manage all the asset, or a house. Okay, what they will do, they will pull all the resources from different individuals. Several individuals are there, many investors are there, many institutional investors are there. So with these all investors, they may have a common investment objective, like that is just to earn good returns, isn't it? So what this asset management company or fund house, what they will do, they will collect money from them. That is, they will pool the investment from these many investors. So these several investors are the ordinary investor, the institutional investors. Okay, so they will pull resources from this investors. So okay, so a fund manager is there who is who's a finance professionally. Okay, he is a finance professional, and he will manage this pooled investment. Okay, a finance manager is there who is a professional, and he is the person who is going to monitor all this fund and is going to manage all this fund. Okay, that is the investment, this pooled investment. Okay, so the manager, he will purchase securities such as stocks and bonds, which are there, which are in line with the investment mandate. Okay, so in short, what I want to say is investment, it's actually mutual fund, it is actually an investment vehicle where various investors are allowed to pool their resources so that they can purchase the stock, the bonds, and other securities. So student, just go through this diagram. Here you can get an idea of what exactly mutual fund is. So if you see, just a minute. Okay. See here what investors do, they will pool their money. What money they have, they are going to pool their money. Okay. Now this money, okay, what the fund manager is going to do? Fund manager is going to invest the pooled money in to securities. Okay, so investors are there who will give their money, isn't it? They are investing their money, so they pool their money, and what the fund manager is going to do, he is going to invest this pooled money in some securities. Okay, when money is invested in security, definitely income and dividends are generated, correct? No, when money is invested in shares, they are definitely going to give out some dividends. Okay, for example, in the shares of one particular company, if that company is making profit, they are going to pay dividend to the shareholders. Correct? No, same goes here. So fund manager, what he does, he is going to pull this money into some securities. So these securities, they are going to generate income and dividend, and this income and dividend, it is distributed among the shareholders. Okay, so this is how the mutual fund is going to work. Okay, understood? No, students, just once again I'll explain. Investors, they pool their money. Okay, that is, they invest, they give out their money, they invest. So when this money, it is pooled by the fund manager, he is going to invest this pooled money into some securities. These securities, they will definitely generate some income and dividends. These income and dividend, they are distributed among various shareholders. Okay, understood? So mutual fund, as you can see on the screen, it is a company that pools money from many investors. Okay, mutual fund, it is a company, it is going to pool money from various investors, ordinary investors, institutional investors, who have a common objective of like maybe to earn some good returns on their saving, isn't it? Okay, so and this money that is pulled from various investors, it is invested in some securities, such as we have the stock, the bonds, and short-term debts. Okay, so this combined holding of this mutual fund, it is called as the portfolio. Okay, so investors, they buy shares in mutual funds. Okay, understood? No, we'll go through the definition of mutual fund. So a mutual fund is a professionally managed investment scheme. Okay, it is professionally managed. Why? As I've already said, there is a finance manager and he is a professional. He knows how to manage the pooled resources, the money that is pooled from investors, how to manage it correctly so that they are correctly invested in the right kind of securities that generate a very good dividend or income, and that which can be given to the shareholders, that is, which can be distributed among the shareholders. So a mutual fund, it is a professionally managed investment scheme, usually run by a asset management company. I've already said mutual fund itself, we call it as a company which is going to pool the money, the resources from various investors. Okay, so it is run by a asset management company that brings together a group of people. Who are this group of people? They are actually the investors. Okay, so bring together a group of people and who invest their money in these stock, bonds, and other securities. Okay, so mutual fund, it is actually a asset management company which is professionally managed by a finance manager, okay, who will pool the resources from various investors, and these people, they are investing their money in the stocks, bonds, and other securities. Okay, so student, I hope you have understood the definition of mutual fund. So students, mutual funds, unlike securities, okay, unlike stock, I mean to say, they do not invest only in a particular share. Okay, instead what they will do in mutual fund, it's in a mutual fund plan, uh, various instruments are there, various options are there, so that investors can get the best possible returns. Okay, so here investor, they need not worry about the choice of share they have to make. Okay, they need not think which shares to purchase, okay, or which are the best stock that are performing well that need to be purchased. No, that nothing to be done. As I already told, no, mutual fund are asset management company. Okay, so people will buy the stock, the bonds, the securities of such companies. Okay, that is mutual fund. So here, which is the best performing stock or which is the best performing bond, that is the as an investor, he need not worry about these things. Why? Because the finance manager is there. Here, a fund manager is there and his team is there, a team of analysts and market researchers. Okay, so these people, this team of fund manager, the market researchers, the analysts, they will do the research and they will choose the top performing instrument that have the potential of offering a very high returns. So in the mutual fund, people, the investor, he need not worry about the best performing stock or which share he should purchase. He need not worry about this. Okay, so here there is a team of people who are going to do. So mutual fund, the even to an ordinary investor, he is going to get the services of a professional. Okay, a professional service is going to get. Okay, like other than mutual fund, if in other shares, ordinary shares, if he is purchasing, he has to use his brain. If he is not going through a broker or an agent, but if he is directly going and purchasing, definitely he has to make sure that the shares that he is purchasing is performing well in the market. Okay, that company is performing well, so returns are very high, that company is into profit. These all things he has to take care of. But when it comes to mutual fund, these things he need not worry about. Okay, he has to just give out his resources and the company, they will take care of the resources. They will use the money of the investor and they will invest this into various securities and make sure that the investor is getting a very good return. So mutual fund investors, that is the money is allocated, and the fund units are given proportional to the amount it is given to the investor. Okay, so student, if like if suppose if you are investing in mutual fund, you will you will give your resources, you will pay the money. Okay, and for the paid amount you will be allocated with certain fund units. Okay, so these fund units, so investor, the returns that an investor would get will depend upon how much units is held by him. Like as a as you as an investor, okay, every, like for example, you're investing, like if you're invested a lump sum amount, so accordingly proportionately you will get certain amount of units. Okay, so how, what would be the returns would depend on how much units you have. Okay, that is how much units were allocated to you when you were invested. Okay, so each fund unit, they has the exposure to all the securities. Okay, so fund manager, they choose the portfolio. Okay, fund manager will choose the portfolio. So here the fund, the units that is the provided to an investor, okay, depends on the various securities that are available in the portfolio. So it will be correctly managed by the fund manager. So the fund unit, it does not provide investor with the voting rights in the company. Like as I said, no equities. When a shareholder, if he goes for equity shares of a company, definitely is going to have voting right. But it's not the same when it comes to mutual fund. Mutual fund, here they are purchasing the stock, the bonds, the securities of one particular company. So here an investor will not have any voting right. He is just investing his money and accordingly here he is going to get certain amount of units. So as and when he wants the liquid, that is as and when he wants his money back, he can give out this unit, that is redeem this unit and get his cash back, that is get his money back. So definitely he is going to earn certain amount of returns. So investing in mutual fund, the investor need not worry about the risk. As I already told, he need not take any tension about the risk involved in mutual fund, because here the fund manager is there. Okay, he will try to mitigate by investing across several instruments. It's not that he is investing the money pulled from investor in one particular instrument only. He is going to invest in several different instruments, so that the risk is, I'll not say eliminate, but it is reduced to far extent. Okay, so here the investor, he need not worry about the risk, because fund manager, he is definitely a professional and he knows his work, isn't it? So investing in mutual fund, it is an excellent way of diversifying the investment portfolio. Okay, in the first chapter, when we were discussing the first chapter, I was keep on telling you, I used to tell you what, that don't keep all the eggs in one basket only. You have to diversify the investment. What did it mean? It means that entire savings should not be invested in the shares of one company only. If you, so for example, if you are investing 10 lakhs in the shares of one company itself, what happens if the company goes wrong, like bankrupt, anything goes wrong with that company, share prices will fall down. What about the 10 lakh that you have invested? Okay, and entire, you will be lost. A person who is investing in the share, all the shares of one particular company, he is definitely in loss. So instead, what is to be done? You have to diversify the investment, in the sense, you have to select shares of different companies, that which are performing well, that which are giving very high returns, that which are giving even low return companies. Okay, so what happened here, the risk is mitigated to some extent, it becomes neutral. You might earn a very good return in the shares of one company, and in other company there might be liberal, the neutral, what I say, the returns will be very little bit less. But when you combine these things, okay, you have earned a certain amount, definitely you have earned. So here risk is reduced. So when you diversify your investment, possibility are there, at one point of time you are earning a very good amount, other part they are, you might have lose certain amount. So it's not that the entire amount you are losing. No, here you have the scope of making good money. So thing is that you should diversify your investment. These things we have already discussed in the first chapter. So here an investor need not think about diversifying his investment if he is investing in mutual fund, because here the fund manager, he will do these things, that is diversification of the investment, the fund manager will do. He and his team, they will easily diversify the investment for the investor. Investor has to just pool their resources, pool their money, give out their money, and that money will be utilized, or it will be invested in various different instrument. Okay, student, I hope you have understood the concept of mutual fund. Students, we will now discuss about the types of mutual fund, or we also call it as the classification of mutual funds. Okay, so here on mutual fund, they have different types. Okay, there is a classification. Okay, so based on what is the aim of the investor, what is the objective of the investor, whether high returns, low returns. Okay, depending on the risk involved. Okay, so same, based on that, the different types of mutual fund we have is, it is mutual funds which is based on asset class, mutual funds which is based on structure, and mutual funds which is based on investment objectives. Okay, so now when you go through the sub classification, you will understand that some part of this classification we have already discussed when we were discussing the second chapter. Okay, so we have the asset class, we have the mutual fund which is based on asset class, mutual fund which is based on structure, and we have mutual fund which is based on investment objective. Students, we will now discuss about mutual fund based on asset class. Okay, so the first type under asset class, we have the debt fund. Okay, now debt mutual fund, they invest mostly in debts, and we have the money market and also the other fixed income instrument. Okay, fixed income instrument, debt instrument, debt fund, they are also called as fixed income instrument. Okay, why fixed income instrument, I'll let you know. Now debt mutual fund, it is actually the money, it is invested in government bonds, we have the certificate of deposit, we have the treasury bills, okay, and many other high rated securities. So when 65% of the portfolio, if it is like minimum 65% of the portfolio, if it is invested in debt securities, it is considered that mutual fund, it is considered as a debt fund. Okay, students, understood? Mutual fund, it is considered as a debt fund when 65, minimum 65% of its portfolio are in debt securities. Okay, so these debt securities, they are actually perfect for those investors who do not wish to take much of risk. Okay, who are risk averse, what we call those people who don't want to take risk, who don't want like higher returns, they do not require, they are fine with less returns also. So they want their money to be safe, they don't want to incur any loss they don't want to lose out their money. So what they will do, they are going to the money, when the intention, the objective of an investor is known, like he does not intend to take much of risk, then his money, it will be usually invested in debt funds. So when 65% of the invested money, when it is invested in this kind of securities, we call it as debt fund. What kind of security, students, tell me? It is actually the government bonds, we have the certificate of deposit, we have the treasury bills. All these are fixed income securities. They are going to give a certain percentage of fixed returns. So here, those people who do not wish to take much of risk, they can invest their money in the debt fund. So debt fund is suitable for risk averse investor, those people who do not wish to take much of the risk. Okay, so this type of debt fund, I have already said, it is predictable in the sense you will come to know, like after a particular period of time, what amount of interest you are going to get, how much will be your returns, how much money you have invested, and what are the returns that you are going to get. It's much predictable. Why? Because here the returns are in like certain percentage, so you know what money you have invested and how much will be the returns. So debt funds are less risky when compared to the other funds which are available. So this type of fund, as I have already said, it is most suitable to those people who do not wish to take much of risk, and their intention is that a steady income should be there. Okay, so for those type of people, those type of investor, mutual fund, that is, which is debt fund. Okay, when 65% of the portfolio, it is invested in this type of securities, that is government bonds, we have the certificate of deposit, we have the treasury bills. If like fixed income instrument, if the amount is deposited, invested, we call it as a debt fund. Okay, so the second classification, or the second type of mutual fund, which is based on asset class, is actually the equity fund. Okay, first one is debt fund, second one is now equity fund. Okay, now students, if you can see the name itself, it suggests the equity fund. It is the investment is mostly in equity shares of companies, which is across all the market capitalization. Okay, this money, the investors money, which will be pulled from them, and it will be invested in equity shares of a particular company. So a mutual fund, uh, under equity fund, it is categorized under equity fund, or I'll put it in an easy word. Mutual fund, it is said to be an equity fund when 65% of the portfolio is in equity instrument. Okay, understood? No, 65% of the portfolio, if it is invested in equity instrument, then that fund, we call it as equity fund. If it is less than 65, or it is 50% less and more of it's invested in the debt instrument, we call it as debt fund. Understood? No, when 65% of the amount invested is in a debt instrument, we call it as debt fund. When 65% of the portfolio is invested in equity instrument, we call it as the equity fund. Okay. Now equity, as I've already shared, it is linked with the market movements. Equity shares that it is actually linked with market movements. So here the chances of earning good returns is very high. At the same time, there is also much risk because, as I already said, it is linked with market movements. So as and then there are certain changes or there is influence of certain economic factors or geopolitical factors, definitely it will have its impact on this equity fund. So there are chances that the share price of this particular fund may go high, and there are chances that may fall down also. So depending, risk is too much there, but thing is that the returns are also very high. So equity fund, it is usually what we call linked to market movements. So here the risk is very high, but if you are planning to go for long-term investment, then definitely equity fund would be the best choice. Okay, so I hope you have understood. Under mutual fund based on asset class, the first fund what we have discussed was debt fund, and second one is equity fund. Debt fund is less risky, okay, because that is not connected to market. Their fixed return of income is there, but here this is equity fund. It is connected to the market. It is like linked to the market, and here it linked to the market, and with the given changes in the economical and political factors, geopolitical factors, it will have an impact on this fund as well. So the degree of risk is very high, but at the same time, there are also high rate of returns. The money can be made in a very quick manner if you're going to invest in equity fund. And the third type of fund, okay students, the third type of fund, that is mutual fund, which is based on asset class, is the hybrid fund. The first one was debt fund, the second one was equity fund, third one is hybrid fund. Hybrid fund means it is a combination of both, little bit of debt fund and little bit of equity fund. So here there is a balance, there is a mixture of both the type of fund. Debt fund, risk is less, returns are also less. Equity fund, risk is more, returns are also more. Now hybrid, this is the best method, this is the best fund. Why? Because here there is a combination of both, the mixed fund is the debt fund as well as the equity fund. So the main objective of this hybrid fund, it is actually to balance the risk reward ratio by diversifying the portfolios. When it seems like there will be high changes in the equity fund because of certain effect of like economic factors or certain impact of geopolitical factors is there, because of which chances are there that equity fund prices may fall down. So immediately the diversification be turned into, the funds will be diversified towards the debt fund. So when hybrid fund are opted, definitely there is a choice to switch between equity and debt funds. So here it is actually a balance, a mixture of both, where it is actually benefiting the investor. So like debt fund, the returns are not very less, and like equity fund, the risk is not very high. You understood, no? Debt fund, risk is less, returns are also less. Equity fund, risk is more, returns are also more. To balance and to give benefit to the investor, fund manager, they will invest the money in hybrid fund. So here it's a combination of both, where there is good returns also, at the same time there is less risk also. Okay, so here the investor is the person who is benefiting in order so that the risk levels are reduced. So hybrid fund, it is actually the excellent way of investing and diversifying the portfolios, so that an investor, he could get an exposure of both equity as well as debt instrument. Okay, as I have already mentioned, mutual fund based on structure, we have the open-ended mutual fund and we have the closed-ended mutual fund. Okay, now open-ended mutual fund, it is actually a very common type of mutual fund available. Why? Because here the investor, he can trade the units by himself, which is based on the NAV, that is net asset value. Okay, so here an investor, he can exit at any point of time. Okay, there is no compulsion that he should if he has purchased, he should stay for a longer period of time. There is no as such compulsion. As and when he want to get this money back, he can encash those units and he can get his money back. Okay, so here open-ended fund, it provides an exit time. Okay, any exit time to the investor. Anytime an investor can exit, because whatever the NAVs, if you see, NAVs are daily published in the fund houses. What is the NAV today? What is NAV tomorrow? What will be? Okay, every day the NAVs are, that is the net asset value of a particular share. It is clearly specified or published. So depending on that NAV, they can withdraw their units. Okay, as much units they have purchased, that units they can sell out and they can get their money back. So here they have a exit period. That is any time they can exit. Okay, that is what we call as open-ended mutual fund. And then we have the close-ended mutual fund. Okay, open-ended mutual fund, investor can exit anytime, but same is not the case with close-ended mutual fund. Close-ended mutual fund, investor, they cannot trade their units. Here everything is dependent on the demand and supply, just like the stock. Okay, so close-ended mutual funds are not as liquid as open-ended, because there anytime an investor wish to exit, he could have got his money back, he can get his cash back, isn't it? He can sell out his units, because based on the NAV he will get whatever is the amount he may get it. But same is not case with the close-ended fund. Why? Because here they are not as liquid as the open-ended fund, because a very less number of people trade in close-ended mutual fund. So this is actually, there is no exit until the end of the specified period of time. A particular investor, if he is invested in close-ended mutual fund, means he has to be there for a specified period of time. At the end of that specified period of time, he can exit. So before that he cannot exit. Okay, The price are also very less compared to that of the normal price per unit. Why? Because here less number of people trade. Okay, why? Because here that option, anytime exit option is not available. So because of that, the less volume of trading, the prices are comparatively less than the normal price per unit. So investor, they cannot enter or exit from the scheme until the scheme end. So here it's not in the hands of the investor to exit anytime or enter anytime. They have to follow the rules as per the scheme. They can enter and exit as per the term which is mentioned in the scheme. Okay, so this is close-ended mutual fund. So based on structure, mutual fund, based on structure, we have the open-ended mutual fund and we have the closed-ended mutual fund. Okay, students, understood? No? Based on mutual fund, based on equity class, asset class, we have equity fund, we have debt fund, and we have hybrid fund. Okay, mutual fund based on structure, we have the open-ended funds and we have the closed-ended mutual fund. Okay, so now we will discuss mutual fund based on investment objective. So mutual fund based on investment objective, we have the growth fund. Okay. Now those investors who wish to make, who are ready to take high risk, and if they wish to have a high rate of returns, okay, then the growth fund is for them. Okay. Growth fund, here the money is invested in growth fund. The major intention is capital appreciation, that is increasing the saving. Whatever money is invested, that money should be increased. How that can be increased? Because majority of the fund, as I said, it is invested in equity. Okay, so here the risk is there. The growth fund is very risky, but at the same time they tend to offer high returns, high rate of returns are there. So those people like who have big dreams, who wish to, maybe they want to purchase a house, or maybe they want to go for a brand new four-wheeler, or maybe like something big dreams are there. Going for higher education, in the sense like going for MS or MBBS, like, okay, so in that case growth fund is for them. Like they want money immediately, isn't it? And for that they are ready to take any sort of risk. So financially sound people, they can go for this type of investment, because they might do have a backup plan if anything goes wrong. If the risky, we say this growth fund is risky, isn't it? So if the market crashes or the prices of the share goes down, and if they're in entire loss, so they definitely they would have a backup plan as well. So growth fund, those people who are ready to take high risk, at the same time who are ready to invest, who want high rate of returns, they can definitely go for growth fund. So this fund, as it is clearly mentioned, based on investment objective. What is your objective? If you are ready to take risk, and if you want money immediately, that is if you want high rate of returns, if you want the money to grow immediately, then growth fund is the option available. Second option available is we have the income fund. Now, objective of this fund is those who want to invest. They want to invest the money. Investors, they wish to invest, but at the same time, they don't want to take too much of risk. At the same time, they also want a steady income. Then income fund is for those kind of people. So here, money get invested in fixed income instrument. You understood? Debt fund. So here money is getting invested in fixed income instrument. We have the government bonds, isn't it? So here thing is that people, the risk also is less, and there is a steady flow of income, but the returns are not as high compared to the growth fund, comparatively less. But thing is that there is a steady income. So investor can, those investors who wish to have a steady income, who wish to increase their money, not by keeping it as a fixed deposit, but little bit more than that, but not as high as growth fund. Why? Because there the risk also is associated more. They don't wish to take much of risk. Okay, so in that case, income fund is the best option available. Less risk, steady income. Money definitely will grow at a neutral space, but thing is that the money is going to increase. Okay, so income fund also is for those people who do not wish to take much of risk. Okay, the next fund we have is the liquid fund. Okay, now the term itself suggests, isn't it? What is liquid? Means any time the investor may wish to have his money back. So in that case, usually they prefer short term investment. That is, the duration is very less. They wish to invest, but it is for a short period of time. Any moment they wish to have their money back, the liquid option should be there. That is, they should be able to get their cash back immediately in the time of uncertainties. As and when they required, instead of, like, thing is that when we have money with us, isn't it? And instead of keeping it as fixed deposit, we are planning to invest in some securities. But when there is certain uncertainties arise, okay, in case of certain uncertainties or financial crisis, why to go for loan when our own money is there in investment? So in such case, what happens? The investor, they think about short term investment, where they can invest, they can earn good returns, but at the same time, when they want their money back, then that time the liquid option also is there. So liquid fund are for those type of objective, those investors who are having a short term investment objective. So in that case, they can go for liquid fund. So in this liquid fund, the money is getting invested in short term financial instrument. For example, we have the treasury bills, we have the deposit certificate, isn't it? So here the risk is also very low, and this is actually meant for those people who are not ready to take risk. Okay, so short term objective also is there. They don't want to take much of the risk, that is low risk. At the same time, they also want the fixed rate of return, like a small rate of return should be there, isn't it? Returns should be there. So when this is the objective of investment, liquid fund is the option available for such investors. The last mutual fund based on investment objective, we have the tax saving fund, or also we call it as ELSS, that is equity linked saving scheme. Now just give a look your attention towards the name, equity linked saving scheme. So it is equity means it is connected to the market movement. Okay, so this is a type of fund which is going to give certain tax benefit. That is, those investor who invest up to 1,50,000 for a particular financial year, they are going to get the tax benefit. That is, they are able to get deduction under Section 80C of the Income Tax Act 1961. Okay, so this is a tax saving scheme for investors. So here, but thing is that since it is equity linked, there is a lock-in period of 3 years. So lock-in period of 3 years means you cannot withdraw the investment, the fund before 3 years. Okay. So, but the positive aspect is that it is giving you a tax benefit under Section 80C. Okay. So those investors who wish to invest money, but their intention is tax saving. So in that case, tax saving fund is the option available to them. Okay. So student, I hope you have understood the different types of mutual fund, that is classification of mutual fund. So we have just, we'll just go through it. We have mutual fund based on asset class. Under asset class, we have the debt fund, we have the equity fund, and we have the hybrid fund. Correct. Then we have the second type, which is the type mutual fund based on structure. So under structure, we have the open-ended funds and we have the close-ended mutual fund. Okay. And then based on investment objective, we have the growth fund, we have the income fund, we have the liquid fund, and we have the tax saving fund. Growth fund, where people are ready to take risk, they are ready to invest amount, and thing is that they should get good high rate of return. So they growth fund is there for them. Okay, those investors who do not wish to undertake too much of risk, but they want a steady income, for those people, the income fund is there, where investment is done on fixed income instrument. Okay, and those people who wish to invest for a short period of time. That is short-term investment. Liquid fund investment is meant for those kind of investor, where they can invest the money and as and when they require, they can get their money back. So that is liquid fund option is available for them. And those people who wish to invest, but they also want certain tax benefit. So tax saving fund is the option available for those people. Okay, students, I hope you have understood the types of investment, mutual funds, various types of mutual fund. Okay, so student, we will stop here. In our next class, we will discuss the remaining topics. Thank you and have a great day ahead.